are not efficient. So a few things that say markets are efficient, right? Mutual fund managers, unit trust managers, and investment analysts don't beat the market on a consistent basis. Don't beat the market on a consistent basis, right? It's actually not just don't beat the market, they beat the market, but not consistently. So what they found through research, right, is that if you look at now, for example, mutual funds and unit trust funds or investment analysts or whatever, what's their job 24/7 in the market? There's hopefully to deliver returns, right? Delivering returns and beating the market are two different things. And when people give money, a lot of the time they expect that investment analysts or mutual funds will be able to beat the market. But when you do the analysis, what you find is a lot of the time, sometimes though mutual funds are able to beat the market if you take the winners and you keep on. So for example, say for a certain period, you look at the funds that have beaten the market versus the funds that have not beaten the market. And then you just take the winners of this quarter, for example, or this period, and you look at over the next quarter or next period, who are the funds that have beaten the market, who are the funds that have not beaten the market. And you keep on doing this over a period of time, you see that very few funds will be able to achieve consistently beating the market, right? So mutual funds, generally, what we see is not just mutual funds, any type of external fund management in terms of investment analysis or whatever, you don't see consistency in form of being able to beat the market. So if you're continuously doing analysis on the market, fundamental analysis or whatever, right, and you're trying to beat the market through fundamental analysis, trying to identify overvalued or undervalued stocks, you should be able to consistently do it if market is not efficient. But the fact that you cannot consistently do it is evidence to say that markets are actually efficient. A Wall Street Journal had a game those days. They call it the investment dartboard game, where they try to do the same thing. They did it in a fun way, where they had a competition among investors, as well as they always got like some analyst to come in and give his top stock picks as well. So they'll ask investors to give their top stock picks, plus an analyst to come and give his top stock picks. And then what they used to do is the journalists, they got in, they would put all the stocks in the market up in the list and they'd throw darts at it, right? The investment dartboard contest. So they'd throw darts at this list of stocks, and wherever the dart lands, that's the stock that they would pick to invest in. And they'd check the results of this investment dartboard contest, where they'd look at the results of the investors, the investment analysts, as well as the darts, to see, okay, randomly throwing darts at a piece of paper and trying to figure out which stocks to buy versus people doing the analysis and coming and saying, these are the stocks to buy. What gives better results, right? So this is the, unfortunately, 2012, 49 years later, or 49 contests later, they wound it down in the print edition. Now they have a different form of the contest in online format, right? So 49th contest in 2012, it's time to pick a stock for Sunday Journal's 49th investment dartboard contest, and you select a stock. So you, the reader, select a stock from the New York Stock Exchange or the NASDAQ that you think will do well over the next 6 months. And then we, the journalists, Wall Street journalists, will then choose 6 read entries to compete against each other, and 6 stocks chosen by tossing darts at stock listings. So the best performance between 1st October 2012 and 31st March 2013, 6 months, wins bragging rights. So this is the last context. Darts win again. Actually, they found that it was 50-50. Asking people to do their analysis and pick a set of stocks that will do well versus throwing darts randomly at a piece of paper and picking stocks based on that, where the darts land, gave 50-50 results, which kind of pointed towards market efficiency. It points towards market efficiency because if readers, after doing their analysis, are able to consistently pick winning stocks, then markets are not as efficient, right? Versus if by just throwing randomly, just picking some random shares and investing in them gives you better returns, then the market is efficient. Okay. It is efficient in terms of you will not be able to do analysis and keep on consistently picking good shares. That's the theory. So 49th last contest, darts win. So it was 50-50. Throughout the fortnight contests, it was essentially 50-50. Sometimes the darts won, sometimes the readers won. But the darts are randomly thrown, were picked stocks. That portfolio should not be the one that is winning if we can do analysis and pick better shares, right? So if you look at the darts won again in the final dartboard stock picking contest, thanks to gains of more than 30%. So readers picked during that period, they had picked Tesla Motors, Buckeye Partners, Royal Caribbean Cruises, and so on. They'd pick this portfolio versus, so this is the portfolio of the readers. Some have performed negative 16%, while some have performed positive 29%, for an average performance of 10.5% in that portfolio, versus the darts have performed 17.5%, from positive nearly 40% to negative 17%, while Dimitri Garrigos, that's the analyst's portfolio, has performed 15%, with a positive of 30.7 to 1.4, right? So you can see here, what we're trying to say is it shows market efficiency because the analysts, nor the readers who do analysis, have been able to consistently beat the market through analysis. Just randomly picking stocks has actually proven better. So in your reading also, there is this, let me just read that. I forgot to keep the place marker. Sorry, give me 1 second. Yeah. Good. So again, same way in your textbook also. Should you hire an ape as your investment advisor? So the San Francisco Chronicle came up with this amusing way of evaluating how successful investment advisors are at picking stocks. And they asked 8 analysts to pick 5 stocks at the beginning of the year and compare it to the performance, compare the stock picks of these analysts to the stock picks of shares chosen by a gorilla, right? An orangutan living in the California Zoo. So what did the results find? It was 50-50, right? Sometimes the ape chose better than the analysts, right? So the orangutan chose better than the analysts. The analysts were not consistently able to pick better shares than the monkey, no, the ape, yeah? So why? Because again, market efficiency. Just because you do the analysis doesn't necessarily mean that you can consistently beat the market if markets are efficient. This case study, Ivan Boesky's case study. Ivan Boesky was an investment analyst in the 1980s, right? He made millions of dollars for himself and his investors. He was an investment banker who used to consistently be able to pick out actually not an investment banker. He, I believe, was an investment analyst. So he was a investment analyst who was consistently able to pick out the next best takeover target, right? He'd pick out the correct companies that would probably be taken over. And by picking those companies consistently, he made millions of dollars for himself as well as his investors, because takeover targets generally mean that at takeover times, the prices rise. Right? So what does that mean? Does it mean that he had a really good knack for picking stocks? No. Later on in 1986, actually, he was charged for insider trading. He was charged for insider trading. So insider trading really is the only proven method. It is illegal, but it is one of the only proven methods of beating the market on a consistent basis. Right? Insider trading is illegal in Sri Lanka. It is illegal in the US. It's not illegal for all countries, but it is illegal for most countries, right? Because you are acting on information that others don't have access to. And you will see, like, in 2011, when the markets were doing really well, but there was a lot of malpractice that were happening in the markets during that time. There's a lot of insider trading that was going on, and SEC was trying to curtail some of this insider trading. And there's a lot of big ha-ho among high net worth investors that was saying that, you can't curtail insider trading in markets such as Sri Lanka. I mean, there was this investor who said, like, markets in Colombo operated almost entirely on insider dealings. This was on a panel discussion, right? And investors are saying that regulations were too stringent, and if you don't make it less stringent, that it can kill the market, right? With same panel discussion, saying insider trading can't be considered as an offense in Sri Lanka because it's a small country and people in Colombo are highly networked. So, but ultimately, if you look at, for example, Raj Ratnam, Sri Lankan origin, Raj Ratnam was the fund manager of Galleon Fund, one of the largest hedge funds at the time, right? The largest. And he was convicted for insider trading. He got, I think he's out now on different things, but he was convicted essentially for 24 years in prison for insider trading. Because hedge funds, again, you had to prove it, but hedge funds, again, work a lot on trying to get information that others don't have. But there are ways that you get information that others don't have. Do you gather that information, put it together in a publicly available information and come up with something that is not easily seen to other people in the public? That's different, right? This is what we call this the mosaic theory. A mosaic is like, those blankets that have, like, you bring different pieces you sew together to create the whole blanket. So this is called a mosaic, right? So you combine pieces together to create the whole. So the mosaic theory says you can act on information that is known by others, but it's information that is brought together from a lot of other publicly available information, and you come up with a theory that is not known to others. That is not insider trading. You coming up with a theory a theory meaning you coming up with a set of information by gathering a large amount of publicly available information is something that you can act on. It is insider to the effect that others are not privy to it. This information only known by yourself and you're acting on that information. But it is not insider because it is created from or deducted from multiple sources of public data. So other than if it's mosaic theory type of information, where you're deducting from a massive amount of publicly available information, if you are deducting it from insider trading, or insider information, then, I mean, in the US, you can see there were massive convictions that were brought in for anybody who is found to be trading on insider information. 2, in favor of market efficiency. Anticipated announcements don't impact stock prices. So studies have found that if you think something is going to happen, then just because it happens does not impact stock price. For example, right? So, oops, wrong side. Okay, let's look at this example. Let's say market has been anticipating a reduction of 25 basis points, and the Federal Reserve, so it's no longer a surprise now, lowered the Fed funds rate by 25 basis points. What would happen in this situation? What would this graph look like in this situation? So markets were thinking there would be an interest rate cut of 25 basis points. And the central bank cut interest rates by 25 basis points and announced it at 2:15 on this date that they cut interest rates by 25 basis points. What do you expect would happen to stock prices? Any idea?
There would be a somewhat consistent slope upwards than the immediate jump.
Yeah, well, not even upwards, right? It will be somewhere in the same region. It will just go on as it is, and it will change for other news. But for this news coming in, there will be no change. There will be no change. Now, do you remember a couple of weeks ago when the sovereign bond deal was kind of signed? There was not a lot of impact to our market. It was not signed, sorry, the announcements came. There was not a lot of impact to our market, right? Because these announcements were expected. Stock prices had already moved up a couple of weeks before that on anticipation that this announcement would be coming. So just because you announced it didn't impact share prices at all. A lot of the time that happens, and you see that when the actual announcement comes, there is no impact. So studies have found that anticipated announcements, if it's not a surprise, it doesn't affect the stock price. What affects the stock price is surprises. Is it a positive surprise? Then stock prices will go up. I'm talking about stocks. Remember, this is the same for stocks, bonds, derivatives, price movements, the same thing, right? We talk a lot on stocks. Just because it's easy to understand doesn't mean all securities that are tradable have the same impacts. Okay. Negative announcements will mean that prices will come down. Not negative announcements, negative surprises will mean that prices will come down. Negative announcements doesn't mean that prices will come down if the announcement is anticipated. Negative surprises will mean that prices will come down. So you always have to look at when a question is given to you, or actually when something's happening in the market, is this a surprise? If it is a surprise, is it a positive surprise or a negative surprise? Positive surprises mean that prices move up. Negative surprises mean that prices move down. Okay. But if it is not a surprise, even if it is a negative announcement, prices will not react. Prices will not react. Stock prices follow a random walk. They follow a random walk. What does that mean? You can't predict which way stock prices are going to move from 1 second to the other. They studies have found that they follow a random walk. For example, if we draw the share price movement over a period of time against its previous day, right, or previous week. So what do? I draw, let's say, John Keel's price movement, how much John Keel's return is today versus John Keel's return yesterday or 1 week ago. So yesterday, John Keel's fell by 0.2%, and today it went up by 1%. Yesterday, John Keel's, or the day before, John Keel's fell by 0.2% and went down by 0.1% today. Like this, I keep on drawing John Keel's or whatever share that I want to, the price movements on a daily basis, yesterday's versus today's prices. And if I got a graph that looked like this, what would you see? What would you deduct from that? What would you deduct from that? If I got a graph that looked like this, what would you deduct? What's your deduction? Y'all are doing econometrics and y'all are doing a financial engineering, financial economics masters. And this is the basic. What is your deduction? There's a correlation, right? There's a positive correlation between yesterday's prices to today's prices. But that's not what you see when you do this type of analysis. And in your previous batches, long time back, we've done these types of analysis for different shares as well as the SPI. And a lot of the time, what we see is you get a graph like this. So whether it's John Keel's or commercial or whatever plantations or the examples that I was using, this is the type of graph that you get. What does this show you? Yeah, so the correlation is very close to 0. There is no relationship between yesterday's price movements and today's price movements. And you see this for each and every stock that you do. If your market is efficient, you'll see that there is no relationship between previous day's price movements or previous week's price movements and today's price movements, this week's price movements. And this is what you see. So stock prices follow, not just stock prices, bond prices, whatever, follow a random walk. Okay. Looking at the Financial Times Stock Exchange, the FTSE index, looking at the S&P, Standard & Poor's Composite, the S&P index, right? Correlations are very close to 0. It is not exactly 0, but it's very close to 0. You can see here when you look at the dispersion of the graph, last week's returns versus this week's returns. You see that you can't see a pattern. Price changes are random, which is in favor of efficient markets, because that's why you can't predict which way share prices will move, because share prices move to the new information that's coming out. If it's not moving to the new information that's coming out, you see a pattern. But because it keeps on moving to the new information that's coming out, you can't see patterns. Which is part of the reason, again, the way we say technical analysis doesn't work. It doesn't help you outperform the market. We're not saying that, EMH is not saying that technical analysis doesn't work to the extent that it won't help you make returns. That's not what EMH is saying. EMH is saying it will not help you outperform the market. It will not help you make abnormal gains over and above the gains that are justified for the risk that you're taking, especially when you take brokerage and all these fees, direct and indirect fees, costs into account. So this is, for example, this is a blog. So it's an older blog article that I found. But those days, a technical analysis are patterns, right? You can find patterns on anything. So a famous indicator that is there based on patterns is what we call, this was in the 1920s, this was developed, I think. Yeah, 1929, 26. It was developed, called the hemline indicator, which kind of looked at over the last, whatever, for a long period of time, how the market performed against women's fashion. And based on women's fashion, the length of the hemline, right? They said that markets perform better shorter the hemline, markets perform worse longer the hemline. Hemline indicator. You can find patterns in anything that you want to. And based on the hemline indicator, you can look at today's fashion and then figure out whether you think markets are going to do well or not. So this is like a blog article that was there in terms of looking at current fashion trends. Hemlines were longer, and so during that time, you were expecting markets to not do so well. Hemline indicator flashes bearish, right? Bear markets versus bull markets. So you have to be a little bit careful when you're looking at these indicators, because what we're saying is, when markets have random walks and you can't predict which way stock prices are going to go, because stock prices depend on information that is coming out all the time. You have new information coming out about exchange rates, about interest rates, about the economy, then about the company's specific information. So much information coming out. And for every single piece of information, there is a small tweak that is required that will change your expectation on prices. Therefore, you cannot predict, use past trends to predict which way future prices will move, right? Which is why we say technical analysis does not outperform the market, especially on a consistent basis, especially after peaks. So those are some evidence to say markets are efficient. Evidence against market efficiency. Evidence to say that markets are inefficient. So not inefficient market theory. So studies have found that there is something called a small firm effect. If you buy a smaller company versus a larger company, studies have found that you make higher than expected gains from small companies versus large companies. Can you explain this? If you buy small companies, you make higher returns than if you buy your John Keelses or commercial banks or the larger entities. You make higher returns than the large entities. Can you explain it?
Potential for proportional growth is high in the smaller companies.
Okay. Potential for growth is high. What are you kind of saying? Smaller companies have technically probably higher risk than larger, more established companies, right? So
Yes.
smaller companies anyway should give you better, or should have the potential, because it's not about giving you, no, it's about the riskiness, but should have the potential for better returns than larger companies, because larger companies are more stable versus smaller companies have higher risk in terms of the growth trajectory. Right? But what studies have found is this higher return is higher than what is justified by the riskiness of these companies. So what they have done is they've looked at the return of these companies against the CAPM return. CAPM return says the return that you want is your risk-free rate plus the premium for market risk, right? So that's what CAPM says. And this is what we say, this is our cost of equity. This is the return that you want to get when you're investing in a company. But when they analyze smaller companies, what they have found is these companies give you much higher return than what is justified by capital. So small company effect, essentially what they do is they take all the companies in the market. Let's say you have 100 companies in the market, and they divide it into the top 10 firms, the next 10 firms, the next 10 firms, like this. The highest decile to the lowest decile, they keep on dividing this, right? So these are the smallest companies. And what are the returns of these companies? And these are the largest companies. And what are the returns of these companies? What is the return you should be getting? The CAPM return of the larger companies to the smaller companies. What is the difference? And you can see that small firms, this black line, has a higher difference against what you should get versus these are very close to zero. Very close to zero. So that's fine. That's okay. Why is this evidence to say that market is inefficient? It is evidence to say that market is inefficient because if I know this, if everybody knows this, if market is efficient, then you should have enough people who know this effect, know that smaller companies will give you better returns over and above the riskiness of the company. And you should be exploiting that opportunity by buying smaller companies. As everybody wants to buy smaller companies, the demand for smaller companies should go up, prices should go up, and this effect should disappear. You should not have this high of an excess return. It should come to like these very low levels. But it doesn't happen. Over the years, the small company effect persists. It doesn't disappear. If there is a pattern and it doesn't disappear, that is evidence to say that markets are inefficient. If there is some sort of pattern that should disappear but doesn't disappear, then that's evidence to say that markets are inefficient. So here you're seeing the small company effect. You're getting higher than required returns, higher than the risk that you're taking, returns higher than the risk that you're taking. That's abnormal returns. That's good. For the riskiness of this company, a return of 20% is justified. If you invest in this company, you will get 40% returns. So if I'm going to get 40% returns, I will be investing in that company. You will be investing in that company. Everybody should be investing in that company, driving up the prices, and the end that anomaly should disappear. So the next set of people who invest will not be able to make that same type of returns. But it doesn't happen. Consistently over time, smaller companies have given much better returns over and above the risk than larger companies, over and above the risk that is justified than larger companies. And that small firm effect not disappearing is evidence to say that markets are not efficient. Same way, you have what we call the January effect. January effect again is an effect that is there that hasn't disappeared over time. So if you look at, you don't see the January effect a lot in Sri Lanka. There's a certain reason for that. But if you look at, for example, in countries like the US, you generally see December has the worst performance and January has the best performance of all 12 months. So if you look at the performance of all the stocks in different months, January, February, March, and so on, right? January has a very high return compared to the other 12 months. Every year, January gives you the best returns compared to any other month of the year. Consistently, continuously. January will give you better returns than other months of the year. Consistently, continuously. Why is the reason for this? For example, in countries like the US, the what do you call it, the tax year falls in December, right? And if any of your shares are making losses, you can actually realize the loss and claim it against your taxes. So if you realize the loss, you can claim it against your taxes. So that's what a lot of people do, they realize any losses that they have in December and they claim it against their taxes. So a lot of the time you see that share prices, there's a lot of selling that happens in December. So share prices fall. Versus in January, it's a new tax year. People start to buy back the shares again, which is why, again, there is demand that is built up in January with the new tax year, new financial year, all of this coming in. So therefore, January share prices go up. December share prices come down. So from a low base to a high base, January, you consistently see investors get higher returns in their share in the market versus any other month of the year. Now, you know the reason for this, but the problem is, why doesn't it disappear? Why isn't it that if this reason is the valid reason, there are big funds like CalPERS, there are massive funds that don't have tax consequences. Like, for example, pension funds, they don't have to pay taxes. They don't have tax consequences. So when others are selling, they can buy in December, when prices are coming down. And when others are buying, they can sell to them. They can make that abnormal return, but for the others, the return will disappear. So you won't have the January effect anymore. But you see, that doesn't happen. This effect does not disappear. Most of the time, you see that it continuously persists. Evidence against market efficiency. Markets overreact. It's against market efficiency. Remember, we spoke about how markets shouldn't overreact if markets are efficient. You have positive news, prices should go up immediately and adjust. You have negative news, prices should come down immediately and adjust. But markets overreact. Markets go up more and then come back again. Markets go down more and then adjust to the correct levels. Market overreaction continuously happens. How do you avoid overreaction? There should be enough people when you see the prices going up more, they should be selling, and therefore the overreaction should dissipate. But continuously markets overreact. It's against market efficiency. There is a lot more volatility in the market than what is justified by the riskiness of the market. Excessive volatility, right? Meaning, if we say the return on the market is 20% with a risk, the justified risk for that is, I don't know, let's say 15%. Okay. But when you look at how the stock prices fluctuate and you look at the riskiness, actual fluctuations or actual standard deviations are much higher. Excessive volatility. That's because people trade too much. There is market overreaction, which is why overreactions cause excessive volatility. For example, right? Because of these effects, there is excessive volatility in the market that is not warranted. Again, evidence against market efficiency. Mean reversion. Mean reversion means when share prices go, how do I say this? Always you will see, or over a long period of time, you will see patterns. If sometimes certain types of stocks do well and other stocks underperform, then in the next period, the stocks that underperformed will perform better, and the stocks that overperform will perform worse. So it will come back to the mean. It will come to the mean. So you have your share prices will move towards the mean. Now, for example, 2019 period when we saw after the war, right? We saw like the base stocks, like the bigger blue chip stocks in the market flat. 2019, a lot of foreigners were buying these blue chip stocks. So these stocks were overperforming the market. Market went up by 96%, 112%, whatever, right? 110%, whatever. But what were the stocks that were overperforming? The blue chip stocks were overperforming. So and a lot of these mid-tier stocks were underperforming. Then what did you see happen? 2011-12, the mid-tier stocks started to outperform the market, and the blue chip stocks actually underperformed the market, right? So that kind of mean reversion, where what overperformed underperformed in the next period, and what underperformed this period overperformed in the next period. So if I know that's going to happen, what will I do? I can consistently make profits by moving from one type of stock to the other type of stock. If this period the blue chips are making profits, I know that, okay, now get out of blue chips, get into the underperforming mid-tier segment, and next period, the mid-tier segment is going to perform better than the blue chip. Consistently, I can keep on making profits. So mean reversion is again evidence against efficient markets, because I'm looking at a pattern and I'm making consistent profits from that pattern. So mean reversion is a problem that you see in markets across the world, which is evidence against market efficiency. And drift, stock price drifting is another evidence that you see against market efficiency. So in this case, what we're trying to say is, now, if markets are efficient, information should be immediately incorporated into the share price. But research that has been done over a long period of time suggests that this immediate incorporation into the share price happens, but then the share price keeps on drifting in the same pace for more, how do I say it? Continuously for for that same set of information. So, for example, again, the research that was done, what they did was they broke down the shares into 10 segments again, 10 deciles, right? Where they looked at the best positive news that was given, positive surprises, the top 10, if you have 100 shares in this market, the top 10 companies that gave the best news, best earnings results, best earnings surprises, and the bottom 10 companies that gave the worst earnings surprises. And like this, you divided this market into 10 different pieces, right? And they looked at, if you have positive earnings surprises, you know that your stock price should move up and then stay the same. Okay. If you have negative earnings surprises, your stock price should come down. Stay the same, meaning it should move for other information, but not for the same piece of information. But what they saw was positive earnings surprises saw stock prices move up and then keep on moving up. Same way, negative earnings surprises saw stock prices come down, adjust, and then keep on coming down. So although I said, if the market is efficient, you can't read the paper today and then go and buy the share and expect to make an abnormal return. Looks like you can. You can't make the same size of abnormal return. But if there is an immediate adjustment and I read the paper here and I buy the share here, I can still make that abnormal return. I read the paper here and sell the share here because my share has performed badly. I can still avoid further losses from this share because of this piece of information. There is drift in prices. There is drift. Yeah. So this is the decile. So the top 10% of shares that gave the highest positive surprise versus the bottom 10% of shares that gave the most negative earnings surprise. You see that this is the time of the announcement. Positive surprise, there is immediate adjustment, and then there is drift, which shouldn't happen if the market is efficient. It should react to other news, but not the same news. So this is some evidence to say that market is not efficient. So there are both sides of the story. Market is not fully efficient. You won't see a strong form efficient market anyway. Market is essentially you will have different shades, right, in terms of the market being weak form, semi-strong form, and in between different levels of weak and semi-strong and strong. It is not just weak form, it is not just semi-strong form. Depending on how much the stocks have been researched, depending on how much interest investors have for certain types of shares, we see that these markets can be weak form to strong form, efficient at different levels in the same market, for different securities. But EMH becomes a good place for you to start to figure out how stock prices should behave when certain news or new information starts to come out. So the question is, if EMH is true, how valuable are published reports by investment advisors or your research analysts? If EMH is true, how valuable are research reports published by investment analysts for an efficient market? Not much of a value because enacted upon by investors. Yes, correct. So actually, if EMH is true, information on newspapers, published reports, it doesn't give you abnormal returns. It shows you a good stock to buy, fundamentally good stock to buy. But saying that this stock is overvalued, undervalued, other people have already acted on that information. By the time you get the research report or by the time you read it on the paper, somebody else would have already acted on that information. You're not going to be making abnormal returns. If you're happy with the type of risk that you're taking, you will be making normal returns from that company. So EMH says research reports published by analysts are really not valuable. You can't get anything additional than what others are getting. You can't outperform the market by using this analysis. What about hot tips? Your broker calls you up and says, buy this and this is happening. This is a good company to get into right now. Hot tips from different types of people. Brokers are one example. If markets are efficient, hot tips, are they good, bad, what? It's the same, yes. Should you be skeptical of hot tips means should you believe hot tips? You should not, right? Should you be skeptical? You shouldn't. Yes, you should. You should be skeptical, meaning you should not believe it, because it's not that the tip is wrong. It's not that the person who's giving you the tip is not honest. It is the fact that by the time you, the retail investor, receive the tip, somebody else has already acted on that information. Just look at even the broker hierarchies, right? Certain brokers will specialize with retail investors. Certain brokers are assigned to specialize for institutional and high net worth investors, right? And most of the time, the way the hierarchy works is like the newer brokers will, right? I'm not talking about 100% of the time. Most of the time, the newer brokers will deal with the retail investors. The older brokers, more experienced brokers will deal with the institutional or the high net worth investors. And if you're looking at that type of hierarchy, then the information flow would also probably happen in that way as well, right? Again, where your institutional clients or your high net worth clients might be receiving information how fast the information gets disseminated. You as a retail client might not be getting it as fast as some of the other institutions, and you as a retail client might not be able to act on it as fast as other institutional clients might be able to. So by the time you get these tips, it's not that they are incorrect or they are misleading, nothing. They are correct, they are not misleading, but somebody else would have already acted on that information probably. By the time you get it, you are probably too late to the game to make those abnormal returns. Abnormal returns. Stock prices already would have adjusted for that information. Therefore, you won't be making that additional return. We don't quantify, we don't feel it because we invest in a hot tip and we see the stock prices move up and we think, okay, we are happy because we've made a gain from that. But if you quantify it and look at it over the period of time, you probably have not made an additional gain from that trade. And churning the share means that after trading cost is probably high. So every time there is good news, do we say that market prices should go up according to EMH? Do we say every time there is good news, market prices should go up? Yes or no? When there is good news, market prices should move up. Is that a correct statement or not? Because it should be a surprise and it should be a positive surprise. Every time there is bad news, market prices do not move down. Every time there is good news, market prices do not move up. Right? Market prices move only if there is a surprise. If the surprise is positive, you will see that prices will move up. If the surprise is negative, you will see that prices will move down. Can you try this example? Sorry. Ravindu, correct. Miraj, no. Johan, no. I try to think of the reason as well. Eranga, no. Parisi, what is your answer though? You haven't given a conclusion. Correct. Correct. So, good. Yes. So a few of you are getting it correct, some of you are not. Now, when you see a loss, the company has made a loss, right? Uh, Results are released. Company has recorded a loss of 2,750, the biggest loss in the history of the company. You would expect the share prices to come down. You would. But do you see here it says analysts expect and the public expects the company to report a loss of 3.5 billion rupees. Okay? So initially, analysts, before these reports started to come out, now, for example, last year, you all remember, or you all might have heard if you're in the market, sometimes analysts would have told you, we're not seeing orders for like the textile companies, right? So for the textile manufacturing companies like your TJs and whatever, MGTs and all those orders have dried down 1.5 years to 1 year ago. You would have seen, right, that textile industry not doing well, apparel exports going down. When you look at the numbers, also going down. So there are reports, analysts put out reports saying, okay, this is not expected to perform well. And same way, analysts have put out a consensus that says expected loss for the quarter is 3.5 billion. Some analysts might have been slightly higher, some would have been lower, but on consensus, 3.5 billion is the expected loss from this company. That's what the reports have been putting out. This company is going to make a loss. The company comes out with a loss. Right? And when reports are being put out, what happens when before the earnings are released, reports are being put out 1 month before, 2 months before, reports are being put out by different analysts saying, okay, this is my expectation of how this company's results are going to be this quarter, and this company is going to make a loss, and it's going to be a big loss of 3.5 billion rupees, right? Market prices would have already adjusted to this information. Whoever fund managers, institutional investors, high net worth investors, as well as retail investors, whoever will take action on this information, and prices would have already come down. When you come out and the company says, we've made the biggest loss in history, 2.7 billion, the company is not looking at analyst reports, they are just reporting. But for you, you were expecting 3.5 billion loss. Expected loss 3.5 billion, actual loss reported 2.7 billion. It's a surprise. Is it a positive surprise or a negative surprise?
A positive surprise.
It's positive. Because it's positive, although it's a loss, it's not as big as I expected. Right? It's not as big as I expected. Positive surprise. Right? Therefore, what happens? Price will actually go up. Prices will actually go up. As soon as the announcement comes, it's not like that. Prices will adjust up. Okay, efficient market means adjusting up immediately. Okay, so good question. Let me come to the indexing and all that. We're just coming to it, right? So give me a minute. So remember, always check for the surprise. Is it a positive surprise, negative surprise? Check for the surprise. Okay. You all have heard of that joke, right? Where the father finds a letter from the whatever teenager or whatever, where they say, okay, I found a boyfriend or girlfriend, whatever. I've decided to elope. Like, you give a heart attack, and then, like, I've decided to elope. I'm not going to stay in this house any longer. Whatever. And then you give heart attack, and then later on, at the end of the letter, it says, actually, all of this is not true. I've got bad grades. I've got a C for my exam. And now you realize it's not the end of the world, right? Like that, you have to look at the surprise element of it, right? So the fact that or you failed the exam, right? The fact that you failed the exam is not as bad once you know everything else that you expected did not happen. So always look for the surprise element of it. If the company reported loss of 3.5 and the company reported 3.5, how would this answer change? Expected 3.5 and reported 3.5. How would this answer change? Yeah, stock prices would simply keep on. You publish the results here, but nothing would happen to stock prices. That's why sometimes people always talk about the fact that results are so good, why aren't the stock prices going up? Results are so good, why are the prices coming down? It's part of the reason of why prices have already adjusted to these expectations. Once results come out, all that happens is prices readjust to the new expectations. If there's nothing to adjust to, prices will remain the same. So, if this is the case, if efficient markets are true, and we know that efficient markets are true to an extent, right? What is the prescription for the retail investor? Because efficient markets say if markets are efficient, you can't beat the market. Especially you can't beat the market continuously. It doesn't make sense for you to do a lot of research and try to find out shares that are overvalued, undervalued, right? For the retail investor, I'm not talking about every investor, and I'll tell you why. But for the retail investor here, I'm talking about, right? For the smaller investor who's a price taker, right? It doesn't make sense to go through the report, to do that complicated analysis, to buy, sell, right? So what's the prescription? So we say if we are in efficient markets, really retail investors should not be looking at active portfolio management. They should be looking at passive portfolio management, because in an efficient market, passive management, meaning passive investing, is the best. Don't try to beat the market. Don't try to beat the market. Follow it. If you believe markets are going to do well, invest. Don't try to pick and choose the stocks you are going to invest in. Invest, hold, right? And ideally invest in index funds. So Tarindra, that's the question that you were asking. Ideally invest in index funds that follow the market or track the market, right? Active management means that you're going to waste a lot of time and energy doing all this research and then buying shares, yes, which will give you good returns, but not necessarily beating the market because others have already taken action on it. So you as a retail investor will not get that additional alpha by doing all this. And when you take out the cost of doing all of that, you're not going to get that additional alpha. Right? So for you, the retail investor, the best prescription is buy and hold or passive investing, especially following the market through index funds. Not continuously trading, not trying to find shares that are undervalued, overvalued. Buy and hold, passive investing, right? Passive investing means either buy and hold fundamentally good shares, meaning shares that you're willing to take the risk of over a long period of time, which is kind of like Warren Buffett's strategy. Find fundamentally good shares, hold it over a long period of time, because the shares in itself will grow if the company is good. That's Warren Buffett's strategy, right? Or index funds, where you follow the market. Index funds are what we call the tracker funds, where they try to follow the market, where they track the way the market moves, right? So you can buy and invest in an index fund. So for example, in Sri Lanka, we only have one, I think there is one mutual fund. I keep seeing it from time to time. So the S&P/SL, the Apico Atraxia S&P/SL 20 mutual fund, that's an index fund, a tracker fund that is there. But you don't have any other index funds that are available. Index meaning index to popular indices, funds that are available at the moment, I think. But like, for example, in the US, you would have index funds that are tracked or that track the market, right? So what would happen is if your S&P goes up, then the fund would also go up. If your S&P comes down, then the fund would also come down. You are following the market through an index fund by investing in an index fund versus trying to beat it. And does that answer your question?
What I was thinking is, ma'am, like if say some index fund is to follow the market also, like you wouldn't know how the market will behave, right? The indices will behave. So for that also, they have to have some sort of strategy so that they go along with the market.
Yeah. So they do have a strategy that goes along with the market. So either you will replicate it one-to-one, Meaning, for example, if you have the S&P 500, for example, right? I'm saying if you are going to replicate it one-to-one, if you have the S&P, I take an easy one, the S&P Sri Lanka 20, you have 20 stocks here, right? In the 20 stocks, the maximum that you can have within one stock is also 15%. So say you have within those S&P SL20, you have Jones, you have commercial, right? You have HNB, some path like this, you have 20 different stocks, CIC. And within that, 15% of the index is John Kears, 15% of the index or 10% of the index is commercial bank. Like this, you will know, you can track where this index is, right? So same way, you take your 100,000 rupee portfolio, 15,000 rupees you will allocate to Johns, 10,000 rupees you will allocate to commercial. You'll buy commercial shares worth 10,000 rupees. If HNB is 8%, you'll buy 8,000 shares worth HNB, right? So what are you doing? You are now tracking this index one-to-one from your 100,000 rupees. Similarly, index like S&P 500 would also do the same. They can either do a one-to-one tracker of a 500 shares. If you are not going to track 500 shares, then they will do a composite tracker, which looks at tracking it very closely with a very low tracking error, where you look at, like, for example, the top 80 so you know these Pareto principles, right? Sometimes most of the value comes from a few shares, right? Like that, you would look at where now the S&P SL20 also in Sri Lanka is supposed to represent nearly 60% of the market, of the Sri Lankan market. These 20 shares, we have 280 odd shares in our market. These 20 shares represent nearly 60% of our market cap. Like that, the S&P 500, a certain number of shares will represent a majority of their market capitalization, let's say 80%, right? So you don't need all 500 shares in your index. You can replicate it with a certain number of shares that represent most of the movement of this index. And then you can look at a tracking error. So with index funds, you will always see the tracking error also published, so that you can see how much the index follows the how much the fund follows the index.
Right.
Does
So
that make sense?
basically, it would be like replicating the index with the portfolio of shares where the net beta value is 1.
So one to that index, yes.
Right. Thank you, ma'am. Thanks.
Okay, so this is the prescription we say for retail investors, right? For retail investors, try to get into tracker funds, index funds, or try to buy and hold. Don't look at actively trading, because active trading means there's a lot of costs that are involved, which net of costs, you would not be able to outperform the market because you are a price taker. And other institutional investors, high net worth investors are probably acting on this information way before you. If you're buying an index fund, always make sure to buy a low cost fund. Look at the fees, right? Because some index funds might have high management fees, which means your tracking error is high. So look at the fees when you're buying index funds as well. My question to you is, should every single investor in the market not try to beat the market and try to do passive portfolio management, meaning buy an index or something like that? Every single institutional, high net worth, retail, everybody. Every single investor, should they be avoiding active investing because you can't, according to efficient market hypothesis, you can't beat the market. Therefore, you should not try to beat it. You should try to follow it. So why spend the money to try to do that active management? Is that true for every single investor?
if everyone does that, this speculation element will go out of the market and the liquidity levels will drop.
And what will happen?
The market would gradually moving into a stagnant position.
Stagnant means it becomes inefficient. Stagnant means nobody's acting on the new information that's coming out.
Yes.
You can track, if everybody's tracking, who's acting on the information. If nobody's acting on the information, then Apple shares might have new information saying that I don't know, let's take an extreme situation, say company is going bankrupt. Who's acting on that information? The share prices will still be highly overvalued. So everybody can't track. This efficient market prescription is for the retail investor. There still has to be enough people in the market who are acting on the new information coming out. Otherwise, you see that your market will become inefficient again. So this is what we were talking about, either index strategies or buy and hold strategies. Also, without looking at active management, another strategy for retail investors is to look at somebody else doing the active management for you, where you buy a mutual fund, unit trust funds. So you're not doing that active management, because what we say is, for the retail investor, it doesn't make sense to spend that time, energy, cost to do that active management role, because somebody else is already acting on that information before you. But who else is acting on that information before you? Some of the people who will be acting on that information before you would be mutual fund managers, right? Not every single time, but would be mutual fund managers, because that is their job. So another way to do this is to look at the active management component, is to try to then look at investing through mutual funds, where you act like a big investor. So again, with mutual funds, where you have to be careful is make sure that you go for low cost mutual funds where fees are lower. And does it also, in terms of portfolio management, if market is efficient, does it mean that there is no role for a portfolio manager? There's a portfolio manager, meaning a person who's looking after the interest of another investor. Is there no job for them? Okay. So according to efficient markets, what we say is, yes, you're not supposed to try to beat the market, because you can't consistently beat the market. You can act on certain information and sometimes you will come up on top and you'll do better than the others, but you can't consistently do it. So therefore, if an investor gives you money, is there no value addition from you? No, that's not what we say in efficient markets. In efficient markets, what we say is the biggest value addition that a portfolio manager can give the investor is to cater the portfolio to the investor's requirements. Meaning, to look at their age, to look at their tax considerations, their risk aversion, how they are employed, what type of portfolio they need, and to create a portfolio that reflects the investor's personal circumstances that the investor can't do for themselves, right? So, for example, younger you are, the more equity you can have in your portfolio. But as you grow older, because you can afford to take the volatility. When you're younger, equity means that you're volatile. Sometimes you lose money, sometimes you make money, right? But overall, over the long-term period, equity should be giving you better returns than inflation. And I spoke about right at the beginning of this lecture series, like we spoke about the difference between investment, right, and just saving. Okay. And investment is where you can really try to beat inflation and make something additional. And how you make that, how you allocate your portfolio to equity, shares, commodities, property, whatever, looking at your risk, looking at risk aversion, looking at your age, whatever tax considerations that is important for you. That's the big role of the portfolio manager, not necessarily trying to beat the market. Any questions? Okay. So that finishes. This is an interesting blog. If you can just go to it, it has a lot of information on efficient markets with a lot of interesting examples and all that. So that's something that you can look at. Okay, so we can stop there. I'm here for any questions for a few minutes.
When it comes to this mosaic theory, ma'am, like what Michael Berry did, does it go
I'm gonna lost man.
the big short thing?
Well, does it go with the mosaic theory? Yes, because he, if I remember correctly, he went and looked at the how, like, he went to different places and he looked at all these, like, he went and had interviews with different house owners, and he went to all these places where the housing prices were going up and up and up, and he found out that these people were actually losing their jobs and couldn't pay, right? So yes, you could say that it was not on insider trading certainly, but he did analyze a lot of information to come up with that argument.
Thanks.
So we're just at the end of our lecture series. Next week we'll be able to finish. Next Saturday, Sunday, we just have one small session and the alternative investments section. So we should be able to, I don't think we can finish on Saturday, but Sunday, halfway through, we should be able to be done. So thank you.
Thank you.
Thank you.
So do we have to, will we be have, face a situation where we will also have to write a letter after sitting for the financial markets paper, like you said, to our parents?
We'll have to see. I don't know. I don't think you are writing letters to your parents anymore. So.
Okay, well, thanks.
See you.
Thank you, madam.
Thank you. Bye.